Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. US and European futures suggest stocks will continue their move higher as President Trump says he has no intention of dismissing Fed Chair Jay Powell. Tesla shares rally after Elon Musk says he plans to pull back from his work with the US government, this offsetting disappointing first quarter earnings from the car maker. Plus, Intel announces plans to cut 20% of staff as Wall Street gets set for tech earnings. Here in Europe, SAP stock should bounce after its first quarter beat.
Anna, good morning. So Jay Powell has job security, and according to Scott Bessent, it looks like a China deal. Well, a China deal, of course, it's going to get done. We can't continue with this. As a result, Euro Stoxx 50 futures go higher. We're up by 1.7%. S&P futures are higher. We're up by 1.6%. Even the US 30-year this morning is catching a bid, folks. And yes, the dollar regains a little bit of strength. There is much to discuss, and the countdown to the opening trade starts right now.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not. But it would be good timing. It could have taken place earlier. But no, I have no intention to fire him.
The President of the United States runs towards his own goal. He looks like he's going to put it in the top right-hand corner, beat the goalkeeper, but puts it over the bar. The crowd goes crazy. The markets love it. Risk on.
I like your football metaphor. So President Trump, he has no intention of firing Jay Powell. That doesn't mean, as you just heard there, that he agrees with Jerome Powell. It doesn't mean he's going to hold back from expressing his views. We could still be very clearly in a situation where the president is putting political pressure on the Fed chair to change policy. That could still be the case. Do we think he's changed his mind on whether he has the legal ability to fire the chief, the head of the Fed? We don't know. Has somebody got in his ear and said, look, even if you take out the chief of the Fed, there's a whole load of other FOMC members who might not listen to you. So we don't know exactly all of the thoughts going into this, but is it such a sizable change? I suppose the market just relieved that they are not seeing Powell go quickly.
I think there was a suggestion maybe that it would have been a massive own goal. And I think there is a recognition maybe of that in what he has said. I still think he should be cutting rates. I'm not going to fire him. We're going to sort of carry on with the current show that we currently have, which is me criticising and him doing absolutely nothing. That's going to continue for Powell, the rest of Powell's term. Powell's not around for that much longer in many ways.
And as we discussed yesterday, in the meantime, some of the damage is done, not because Powell is going to respond to political pressure, but just by undermining the independence of the Fed. By the more you talk about the ability of the president to interfere, that can do some of the heavy lifting on that. In terms of other news flow that's important in this context, you referenced some of the thoughts on China that we got from Scott Bessent, saying, look, we have to get some sort of deal done here. We can't continue with tariffs as they are, and even President Trump himself saying they're not going to be 140 or so % by the end of this. We're going to get a deal where these tariffs are much lower. He's going to play nice, he said.
Yeah, precisely. And China's going to play nice as well, apparently. And everybody's going to be happy and it's all going to be great. I think Bessent speaks again today at an event around the IMF meeting, so we'll look forward to maybe more comments coming on that a little bit later on today. So, I'm trying to frame this and think about it kind of logically. Something really bad has not happened. So the market kind of quite likes that. This was a huge tail risk, and it would have had a dramatic effect. So I think probably just withdrawing that, you can understand why the risk rally is taking place. How much longer, to your point, it lasts remains to be seen. In some ways, it's a bit like the Tesla story. So let's talk a little bit about Tesla. But let's kick things off by hearing from Elon Musk.
Probably in next month, May, my time allocation to Doge will drop significantly.
He's going back to the company. He's not completely going back to the company. No. And this is the amazing thing as well. So the market cheers as Elon Musk says he's going back to Tesla. All will be well. And again, I just find it amazing. The detail is so important here. He's going back, but he's not completely going back. he barely talked on the call about what is happening with the EV market. Continued to talk about the big shiny things out there, i.e. self-driving cars, robo-taxis and robotics, two huge things which he continues to point to.
Yes.
Why did the stock go up?
I know. I mean, it's amazing, isn't it? Because for some people, for those who are really big fans of Elon Musk and everything he does at Tesla, more Musk is the answer to all the things that have gone wrong at Tesla. For others who don't share that view, but quite like some of the things that Tesla has done, they see Musk as part of the problem. And so you can have different arguments based on your view of how much of a fixer he is, I suppose, for the car maker itself. To your point about how much time he spends with the government, I think one of our stories suggested he'll still spend 1 or 2 days a week working on his Doge project. So that is not a full-time, that's not a 5 days a week CEO.
I'm assuming he probably works 7 days a week.
Well, he probably does, doesn't he? But he's got other businesses to run.
But he's got other,
as well.
There's kind of other things within the portfolio as well. Liam Denning has written a brilliant piece this morning, just kind of working his way through all the numbers and all the details of what we got out of Tesla last night. It's an amazing read. I urge everybody to have a look at it. Regulatory credits accounted for 101% of pre-tax profits.
Yeah, this is
101%.
That's amazing, isn't it? And this has been a long-standing talking point with regards to Tesla. Yes, of course, it's a car maker, but it also benefits from the fact that other car makers don't make as many EVs as they do.
So that's amazing. It's worth pointing out that the Shanghai Motor Show is on at the moment, and there's some pretty shiny toys over there that are being unveiled. The brand damage of his relationship with the company, barely talked about. In fact, not talked about. The only thing you could probably say about Tesla at the moment with a degree of certainty is that it's got a lot cheaper.
Yes. A
lot cheaper. And you do wonder whether that is going to be something that will entice people back in and maybe does account for some of the rally that we've seen overnight coming through. SAP's out with numbers as well? Yes, better than expected numbers out of SAP. And the ADRs, this came last night, European time, so the ADRs had time to respond, up 7% at one point. So there's a lot of recurring revenue at a business like this. You know, the customers are pretty sticky. Once they've spent a lot of money kind of integrating this kind of technology into everything that they do, sort of behind the scenes, that helps. This is now a stock that is bigger than Novo and bigger than LVMH, which I was thinking about and wondering if it told us more about the challenges that Novo and LVMH face than the strengths at SAP, but I'm sure there's some of the latter as well. There is some talk, Morgan Stanley did some research, there's some talk of slower sales in the United States. There's no direct tariff hits here, of course, this is a services business, but the customers that SAP serves will themselves perhaps be coming under pressure from some of the tariff news flow. Intel's going to be interesting as well, so it looks like we are going to see, I think it's going to come out with numbers. The expectation now is, and this is the news out overnight, is they're going to make some big job cuts. And as somebody was pointing out this morning, this probably just reinforces the idea for the market that actually this earnings season could deliver actually quite a lot of bad news, and Intel maybe take some of the shine off the equity rally that we are currently seeing. In terms of other news, Reckitt's out. Looks like it's missed on like-for-like sales. That's probably worth publishing as well and talking about. You've also had a whole load of other numbers out this morning. We'll go through those. Danone is out with figures. I think we also get some quite big numbers after the bell tonight as well. So we are beginning to get into it in terms of the news flow that we're expecting. So Caring's out a little bit later. And I'll just go back to SAP, not because of a particular interest in the numbers necessarily, but because of something the CFO said that I think helps us understand how this earnings season might play out. Because the CFO is saying there is a scenario out there where there is a severe global recession, but then went on to say our outlook is not based on that scenario. And so I think this is the kind of nuanced language that we might get from various CFOs and CEOs as they're talking to the market. There is this really negative downside scenario out there. It's not our base case, and so it's not in our numbers right now. And that's probably something worth bearing in mind. They're not going quite as far as Mr. Kirby over at United, who put out 2 sets of guidance. Yes. But it's coming awfully close to 2 sets of guidance. There is this big scenario, bad things could happen, and as a result of which, if that were to pass, we would change our guidance significantly. What have we got coming up on the show? We've got some great guests lined up for you. Alex Brazier, BlackRock Global Head of Investments, is going to be joining us. Bonia Kong's going to be joining us from UBS O'Connor, CIO of Global Multi-Strategy, also here with some restaurant recommendations. We'll talk to him a little bit later on. John Taylor, AllianceBernstein, Head of European Fixed Income, is going to be joining us as well. And we need to talk tech, and we're going to do more of that throughout the show. Claire Playdale-Bouverie is going to be joining us from Lion Trust Fund Management. Let's talk about some of the data points we've got coming out. We're still stuck in this world, as Guy, you were saying yesterday, where we don't have the hard data necessarily to tell us what's happening, but some of the soft data is building a picture. Euro area PMIs, UK PMIs, US PMIs, we get all those as we go through the day. Andrew Bailey at the Bank of England speaks at the Institute of International Finance in Washington, DC, a reminder of many newsmakers over in Washington for all of those IMF meetings that are taking place.
place. And we get the Fed's beige book. That should give some interesting insight into whether the outlook for the economy is beige or whether something a little more interesting in either direction is happening. And the PMIs in Europe, they're going to be coming out through the show. So we'll get a sense of some of that, again, high-frequency data.
Is it too early to get an inkling that the German PMIs are going to be starting to pick up? Are we going to start to see maybe companies front-running some of this German government spend?
Yeah, I'm really interested in how the timing of the tariffs and the timing of the fiscal stimulus in Germany, they are not likely to be the same. And a lot of analysts saying, you know, tariff pain comes before fiscal benefit next year, maybe. And so which of those dynamics do the PMIs tell us about? I'm not sure. We'll see later on in the programme.
We will break them for you and bring them to you a little bit later on in the programme. What else do you need to know this morning? There's plenty going on. The French President, Emmanuel Macron, is said to be considering dissolving Parliament and holding snap elections within the next few months. Sources say he's discussed such scenarios in recent weeks, but no final decision has been made. Legislative elections are not due until 2029. Macron's approval rating has jumped as a return to international prominence has helped boost his popularity at home. The US Secretary of State, Marco Rubio, has pulled out of high-level talks in London today aimed at pushing forward President Trump's Ukraine peace plan. The deal, which would have recognised Russia's occupation of Crimea, has been firmly rejected by Volodymyr Zelensky. It is now unclear when high-level talks will resume. And Pope Francis's body will be moved to St. Peter's Basilica this morning to lie in state, allowing the Catholic faithful to pay their respects. The body of the Argentinian Pope, who died Monday, will remain there until his funeral on Saturday at St. Peter's Square. Cardinals are expected to begin conclave talks at 4 p.m. UK time. It is typically 2 or 3 weeks before a new Pope is named. 5 p.m. Rome time, probably a little bit more appropriate.
Coming up on the programme then, we will preview US tech earnings. The sector already on alert after Intel announced big job cuts. We've had SAP numbers, a lesson in resilience, according to Deutsche Bank and their research this morning. So we'll talk about some of the big US tech stories that are still to come. Plus, Akzo Nobel CEO Greg Poux-Guillaume is going to be joining us to discuss first quarter results out of the paint and coatings maker. Up next, tariffs continue to add to uncertainty in markets. We'll discuss. If you have any questions for our guests, please get involved in all of these conversations that take place around this desk. IB plus BBTV Go. That is the function. This is Bloomberg.
If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
It's too soon to judge what's going to happen to the path of interest rates. You know, we just don't know right now with confidence, is this a one-time effect on inflation or is it something longer term? Our job at the Fed is to make sure it is not something longer term.
The tariff increases are significantly larger than previously expected. As a result, the economic effects of tariffs and the associated uncertainty are also likely to be larger than we anticipated.
I think that the tariffs actually represent more of a disinflationary risk than an inflationary risk, though, and so we'll have to see how that develops going forward.
Some of the key central bankers we've been speaking with over the last few hours, with the IMF's managing director speaking at the beginning on the continued sense of economic uncertainty. Uncertainty certainly seems to be a word that we hear a lot these days, of course, due to Donald Trump's tariffs, but also some of the other things that have been going on, like the potential future of the chair of the Federal Reserve. Alex Brazier, Global Head of Investments and Portfolio Solutions at BlackRock, joins us now. He previously served as Executive Director for Financial Stability at the Bank of England. Good morning.
Morning.
We live in a volatile world. I read the notes you sent us before the interview this morning, and you talked about the need to diversify, but you need to be careful into what you diversify. How are you thinking about that process? How quickly does it need to unfold at the moment? How much precision can you apply to that process, given the swings that we see on a daily, hourly, minute-by-minute basis?
Well, it's certainly clear, morning, by the way, certainly clear that we're in a new world, a more volatile world. And when it comes to diversification, I think the key thing we've got our eye on is that that nice negative correlation we used to enjoy between US long-dated treasuries and US broad market stock indices isn't reliable anymore. And there's a whole host of reasons for that, including that if growth slows due to tariffs, actually that's not disinflationary in the US. You've got a direct effect on consumer prices. But you've also got supply disruptions stemming from what's happening to supply chains right now, creating more inflation, and to the extent it causes expenditure switching in the US, people may be switching a bit like they did in COVID, actually, in the other way, you're going to see more inflation pressure on domestically produced goods. So the Fed not going to come to the rescue. Plus, you've got a fiscal position in the United States that looks unsustainable. Doesn't mean it's going to correct anytime soon, but it looks unsustainable over the long term. And we see it in the flows. You've got international investors, particularly in Europe, gradually stepping away a bit from US assets. That's all going to add up to a less reliable stock-bond correlation. We could see yields continuing to rise even as we see more volatility in equities. So where do you look to diversify? Well, gold has obviously been very popular and has performed very, very well. Inflation-protected securities in the United States look attractive right now. But I think more fundamentally, we are now looking at portfolios that include more strategies that take down broad market beta, liquid alternatives, and actually generate return with long-short calls and take out that exposure to the broad market. In this kind of environment, historically, those kind of strategies have performed very well in reducing portfolio risk without compromising return.
OK. Alex, good morning. You're looking at precision ways to diversify, and some of the things I picked out from your notes, they're around US healthcare, European banks. Talk to us about the characteristics that you're looking for in I don't know, are they havens? Do we feel the need to be in havens right now?
I would put it into three buckets, maybe. So one is how to construct a portfolio for this new world, maybe with more of these liquid alternative strategies, maybe with some gold. But then within the equity sleeve, I think there's probably two avenues we want to explore. One is, how can you be agile to protect the portfolio amid this volatility? Because forecasting it, you do this every day, forecasting it from day to day isn't really possible. So we're looking at things like minimum volatility strategies, factor exposure that's typically performed very well in these types of environments. But then, as you say, we're also looking for opportunities at the pretty granular level to exploit some of the pricing that appears during these periods of volatility. So, for example, healthcare right now looks pretty attractive on a valuation basis compared to some other sectors. Yes, we've got the potential threat of pharma tariffs coming, but actually it's got a pretty low beta to global growth and looks like a reasonably attractive longer-term opportunity with an entry point here.
Given all of that, it sounds like you're positioning for a new world. Is there a danger? Some in the market still talk about kind of wanting to go back to the old world, i.e. US exceptionalism. We go back to kind of where we were. Trump will be a blip, and ultimately where we were is where we go back to. How high a risk is there of that happening?
Well, I think there's some probability of moving back to where we were maybe a couple of months ago, not least because we've seen that in recent weeks, some of these policy announcements have come up against the hard reality of the economic and market impact and have been walked back. So there is a kind of stabilising mechanism at play there. And many of the things that drove US exceptionalism for a long time, they're still present. US is still a very innovative, tech-centred economy. All those things still exist. But when it comes to diversification, one thing is going to carry on for quite some time. Or two things, perhaps. One is the fiscal position in the United States. Doesn't look to be adjusted anytime soon, which actually makes us cautious about the long end of US Treasuries without more term premium priced in. But the other is, now that we've seen more volatility, we have seen particularly European investors gradually, not suddenly, but gradually demand more risk premium on US assets. Those two things are likely to have a longer lasting effect.
Before this all happened, thinking about the idea that we'd be discussing the end of US exceptionalism and the end of the dollar, even discussing, not necessarily saying it's happening, but is the dollar not going to be the reserve currency, you would think that that would look like a whole lot of panic in markets. And yet these thought processes, in terms of their market expression, has it been quite calm, Alex? Would you even say?
I think when you
not necessarily a huge panic.
No, when you look at recent weeks and months, actually, given the scale of events, the market's been pretty orderly. You've seen days where it's moved quite suddenly and days where it's whipsawed back again. But over the broad span of a month or two, actually the market's been reasonably orderly. But I think that goes to this isn't really a sudden change in the dollar as a reserve currency. This is a gradual shift in international investors' attitudes demanding a slightly higher risk premium on US assets. It's not a sudden kind of step
so it's
change.
that risk premium and a slight change in asset allocation rather than wholesale changing of a view.
Yes, absolutely.
Yeah.
Nevertheless, it does feel like some tectonic plates have moved. And I know we're all feeling quite calm. I feel like they've moved quite quickly in certain respects. The fact that you've got a move higher in US yields and a sell-off in the dollar, that is a big move. That is a big shift that is going to have lasting consequences. As you say, the US fiscal position is now being eyed with a degree of caution. Do you think we've fully understood yet the scale of that shift? If there is a change in the way that the US consumes, if there is a change in the way that the world invests into America, that is a big change that is going to take a long time to play out. How long is this process going to take to unfold? How long is it going to take before we understand what the new world order is ultimately going to look like?
Quite some time is the short answer. I don't think this is something that is walked back within a few months and we're back, as your previous question put it, we're back to where we were and move on. Yeah. I think there are things unfolding here that could take some time, not least the reallocation of global capital flows. So, for example, to the extent tariffs are successful in reducing the US trade deficit, that means fewer dollars moving overseas. It means fewer dollars to be recycled back to the US. That means US investors will need to finance the US fiscal deficit, which probably means higher long-term yields.
Like how much higher?
That's difficult to say, but we've seen recently in reasonably orderly moves, with the exception of a few days.
Yes, and 30-year looked a bit distant.
Yeah, with the exception of a few days.
There was a moment.
And actually, the market's found a new point. That could carry on over time. But we're not looking here at sudden, multiple percentage point moves all of a sudden. We're looking at a gradual reallocation of capital over time.
Because when we look back to the UK episode in 2022, that didn't feel gradual, did it? So is this...
That was the opposite of gradual.
Right.
Yeah.
So this is... We had some sort of self-perpetuating mechanisms built in, didn't it? So, but the 30-year has not proven to be...
No, I mean, in that week, you highlighted there the 30-year, there were some mechanisms at play. Our traders were looking quite closely at what was happening to some of the hedge fund plays in the Treasury market at that point. And those things were acting as something of an amplifier. But broadly speaking, we're just seeing as you put it yourself a moment ago, Anna, a sort of gradual adjustment of risk appetite here and a repricing of particularly European investors' approach.
Do you think the floor is in for US 30 years? Is this the low in terms of yields? What is the range that we could occupy at the back end of the US curve? Yeah,
I'm not willing to call a floor on anything right now, given the news flow. But generally, we expect things to be moving up from here. When it comes to fixed income in the US, we lean towards the belly right now. We don't want to take that duration risk. European fixed income, though, very different, acting as much more of a classic diversifier. Why? Well, Europe's seeing, as a result of tariffs, much more of a growth shock than a kind of stagflationary shock. Same's true in the UK as well. So those things, the long end of the gilt curve, the long end of the Bund curve, actually more opportunity than in the Treasury curve.
OK. Alex, thank you very much. Really good to speak to you this morning. Alex Brazier, Global Head Investment and Portfolio Solutions at BlackRock. Coming up, we will talk about earnings from paints and coatings giant Akzo Nobel, reaffirming its full-year forecast despite first quarter revenue missing estimates. We'll speak to the CEO next. This is Bloomberg. Welcome back to the programme. 30 minutes from the start of the opening trade here in Europe. So let's look at the futures picture. And US trading yesterday was strong. We saw positivity in the United States as the US administration avoided, Guy, as you put it earlier, avoided that own goal. And President Trump said he had no intention of firing the chair of the Federal Reserve. So stocks went higher. And we look for some of that to continue to come through into Europe today. Interesting that we see US futures heading higher still, though, Guy, as if that same dynamic, that same theme, and some of the other placatory language from Bessent and Trump around China has more room to run.
So US 10-year yields are down this morning, which is interesting, but European yields are looking like they're moving higher. So we're going to keep an eye on what is happening there. We've got the PMI data coming through. That'll begin to drop fairly shortly. So I think we're in a kind of little bit of a sort of hiatus here as we just await for that data, and things could change.
And that transatlantic sort of mechanism between Treasuries and European bonds, not what it always has been, as we were discussing with Alex. That's something we'll pick up on later in the programme. Let's, for the moment, get back to the earnings stories, though. The paint and coating giant Akzo Nobel is reaffirming its full-year forecast today, despite first-quarter revenues coming in a little below estimates. The owner of brands, including Dulux, says higher prices and cost-cutting compensated for lower volumes and inflation. Akzo Nobel's CEO, Greg Poux-Guillaume, joins us now from Amsterdam. Greg, so nice to speak to you. Thank you very much for coming in. So I just want to get a sense of the guidance you're giving this morning. You are sticking to your full-year adjusted EBITDA guidance, which is understood. But what kind of caveats would you put around that? What kind of careful language, given the global uncertainties that the global economy faces right now?
Well, the first part of the careful language is that it's a guidance at constant currency, and you can see that the euro is actually picked up against our currency basket. So it's as the euro gets stronger, there's a translation effect. That's mechanical. There's no transaction effect to speak of because we're fairly localized as a business. If you take the U.S., for example, 98% of what we sell in the U.S. we produce in the U.S., and China's the same. So I'd say Forex as a translation. I'd say global demand as more of a reflection of what happens to GDP if this tariff battle continues for too long, because as much as we can mitigate the direct impacts on the Akzo Nobel model, the indirect impact on consumer demand is something that's hard to predict.
Yeah, the indirect effects hard to predict. Thinking about the localization of production, Greg, is that job done? Is all the work done on that front, or do you need to think more about either localization or regionalization of supply chains?
No, it's done, and part of it is the business model of the paints and coatings industry, and part of it is Akzo. So paints and coatings, the products largely don't travel very far because of cost to weight, so you have a tendency to localize. And Akzo's localized more than most, so we have a model that's really quite de-risked. And then beyond that, we took the decision a couple of years ago to also de-risk some of our procurement flows, so to rely less, for example, on China, and particularly less on China to the U.S., but also to Europe to a large extent. So once again, take the U.S., 98% of what we sell we make locally, 90% of our raw materials are also U.S. sourced. So if you take the U.S. and China in the Akzo Nobel model, they're already largely decoupled, which means that the cost and ability to deliver impact of tariffs for us is not very significant. Once again, what is potentially more of an issue is if the world goes into a slowdown, then the tide rises and drops for everybody.
Are you seeing any indication, Greg, good morning, it's Guy, are you seeing any indication of such a slowdown beginning to materialise? What are your customers saying?
No, at this point, we're not seeing anything in our numbers that says that it's materialising. Actually, our current trading is completely in line with last year's. It's more of a general jitter. I think these things take a little bit of time to materialise, investments being pulled back, for example. But one, it's not visible in our numbers yet. Two, 40% of Akzo is essentially decorative paints, retail, and that is driven by local consumer confidence more than anything. And the other 60% of Akzo is B2B paints, coatings essentially, which is GDP driven. Yep. So we're actually quite a good barometer because we have both aspects, and essentially at this point both are holding up. But there are signs that investments might start getting delayed if this continues for too long, because uncertainty is not a good environment for investing.
In terms of the B2B bit, where in that B2B bit would you be looking most closely? Is it in the auto sector? Which areas of that B2B part of your business are you keeping the most careful eye on at the moment?
The U.S. actually, because tariffs are inflationary. So there's a moment where there might be a measurable impact in the U.S. It's been a really good market over the last few years. It's also a really profitable market in coatings in general. And if there was a sign of weakness in the U.S., I think that would weigh on all the paints and coatings players. But at this point, it's too early to reach any conclusions on demand overall. It's still holding up.
And Greg, just to get into some of the detail then, in terms of your business in the United States, are you saying that are none of your products exposed to tariffs then because of the localization of production you described, that cost to, that weight to that weight ratio, that you just don't transport things very far? Is there pretty much no exposure to any of these tariffs?
Actually, there's a little bit of exposure, but the irony of all of this is that the exposure is on the stuff that is harder to anticipate. So, for example, we have a little bit of exposure between the U.S. and Canada, but who would have anticipated that there'd be tariffs between the U.S. and Canada? We didn't. So there's a little bit of mitigation to happen on that side of things. But between the U.S. and China, no, it's already taken care of.
Where are you going to invest? Are you thinking about your shift? You've already repositioned the business. You are geographically hedged. Do you just invest across all of the businesses, kind of given what you have now? Are you going to shift as a result of maybe some of the economic headwinds that you potentially see coming towards you in terms of your investment strategy? Are you going to invest as much going forward? What does the CapEx story look like for Akzo Nobel?
We're comparatively going to invest less, but it has more to do with Akzo than it has to do with the market. Essentially, we are on an efficiency drive. We have pretty aggressive ambitions in terms of increasing our return on assets. And it means that essentially we've got to sweat these assets. So we have invested in the last few years in terms of modernizing our industrial assets. And we've got the capacity that we need. And now we need to be as efficient as we can with that. And you're seeing it in our Q1 results. You're seeing that essentially our cost position is being adjusted downwards, which I think is going to be helpful in the current market environment.
Greg, great to catch you up. Thank you very much indeed for sharing some time with us and some of your thoughts on what happens next. Akzo Nobel's CEO, Greg Poux-Guillaume, thank you very much indeed. We're going to shift to another story next that is a big corporate narrative out of Europe. SAP surprising to the upside in its first quarter results. The US-listed shares, the ADRs, climbing in late trading. We'll have more on that story. And just a little reminder, Kriti's not here, but she's here in spirit. Later tonight, you can catch Bloomberg Chief Financial Officer featuring BBVA's CFO, Luisa Gomez Bravo, along with the opening trades, Kriti Gupta. The show airs 9:30 p.m. New York time for our US viewers and Thursday evening here in Europe. Take a listen to the CFO's view on North America right now.
When you're in emerging markets, you are in volatile environments, more so or less so. Structurally speaking, we do still have a very positive view in Mexico. On the macro side, because structurally speaking, it is a very attractive investment geography for the US. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the US companies not take advantage of that?
It's 100 years, 80 years, 100 years of dollar strength. So much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
100 years ago, we were in the middle of the roaring 20s. Bad things happened after that. I'm just going to point that out just for now. Anyway, that was, of course, the Barclays CEO, CS Venkatakrishnan, speaking at the Bloomberg Sell-Side Leaders Forum. Let's talk about what's happening in the markets this morning. Equities have had a good couple of days, certainly stateside. Let's get more. Here's Val.
Yeah, yes, they have. And globally, we're seeing quite a bounce in the equity market. A lot of excitement over these recent Trump comments. It seems like the Sell America trade is unwinding a bit for now. The S&P futures have now risen 4.2% in the last two sessions, boosted late last night by those Trump comments. We've also seen the dollar strengthen by the most in 2 weeks. Guy, it only took a 40 basis point rise in the dollar to get that superlative. Maybe puts into perspective how weak the dollar dollar has been recently, but in the last 2 sessions, it's up now more than 0.5%. And take a look at the reprieve in the Treasury market as well. Those 30-year yields declining by around 7 basis points. That's the biggest rally we've seen in the long end in 3 weeks' time. A lot of this also happening because there was a reminder from Trump that no, he does not intend to fire the Fed Chair Jerome Powell. But I do want to make an argument, Guy, as to maybe why we should be pushing for more Fed cuts as Trump is claiming for. You can take a look at this chart behind me. This is financial conditions, the Bloomberg Financial Conditions Index. This green highlights looser financial conditions. The red down here highlights tighter financial conditions. Now, since equities hit all-time highs back in February, we've seen a steep tightening in financial conditions. And the president is just claiming, why was the Fed cutting here when we had loose financial conditions, but not urging to not having any urgency to cut when financial conditions are so tight down here?
Well, because the labour market was beginning to wobble and Powell was worried about that. That's the official reason. And also maybe actually inflation is becoming a bit of a risk right now. How much is the Fed focused on that right now, I guess, is the real question, given the fact that the language we seem to be hearing out of Powell is about uncertainty, but also about inflation. He's worried that you don't have a strong financial system, you don't have financial stability if you don't have inflation under control. One is a precursor to the other. Does the chart take that into account?
Well, in some ways, that these Fed speakers have been talking about worried about inflation expectations rising, but they really have not. We've seen very short-term inflation expectation rising, but long-term inflation expectations have remained well anchored. You know, that was repeated by Kashkari yesterday and Adriana Kugler. Adriana Kugler was the one who actually pointed out that financial conditions could actually weigh on growth more than expected, Guy.
Valerie, thank you very much. Valerie Teitel with the latest on the market. It's interesting there then on those tighter financial conditions and the link between that and Fed policy, one we will debate, no doubt, as we go on. Our Markets Live executive editor Mark Cudmore joins us now for 3 minutes on the markets. And Mark, let me come to you. When you look at the tightness of financial conditions right now, can you see arguments for cutting interest rates in the United States, despite the fact that some fear that inflation is coming?
No. I can't see why the Fed should cut rates right now. Ultimately, those tighter financial conditions do cause a threat to financial market stability, which is, essentially a third mandate. But the most important dual mandate of unemployment not yet spiking to bad levels, the labour market, and inflation is their really important one. That's the one where they risk doing long-term damage if they ease prematurely. Now, they may have to cut rates very aggressively later on, but it would be a mistake to cut rates too early if it turns out that the growth is not going to tumble, if the labour market's not going to suffer. And they know now the best approach in these kind of uncertain policy times is to maybe wait to cut a little bit later, but then cut very aggressively. And that's been the pattern established over the last 30 years. So quite often what you get in these kind of markets is that you might get no cut, and then suddenly the Fed cuts 200 basis points in the space of a couple of meetings because they realize they're behind the curve. But that makes sense. It is better policy than cutting prematurely and risking spiking inflation expectations.
Yields are down on the US 30-year. Stocks are up. Do I chase the rally?
It depends how short-term a trader you are. I think the relief rally has a little bit more room to run, but I think you need to be extremely nimble. I just want to be very clear. There is no way that this rally is ultimately sustainable on a longer-term basis. But the relief rally can go a long way. We've had a big move in the last couple of months. And we talked yesterday, we expected the dollar to bounce. We expected gold to come off, and we expected to get a bit of relief rally in markets. And I think that, we might get a continued bouncy relief rally. I don't know the duration in time. It might be another couple of weeks because it might be bouncy, but I don't expect it to go particularly far in power. Maybe another couple of percent in stocks, maybe another 1% or 2% on FX side, but I don't expect it to be much more than that because ultimately a large part of the world is just waiting to sell more dollars when they get better levels to do so.
Do you take any comfort, Mark, from the fact that maybe President Trump and Scott Bessent can sometimes act or bring in some kind of stabilising mechanism when they see certain fallout in markets, as we've maybe arguably seen now with the Powell comments and the comments recently about China?
I think if you're a day trader, it's awesome because it means you can trade these markets in both directions around the longer term themes. Does it provide much relief for business owners? No. Like, it doesn't matter if we get a full policy reversal now. We won't get policy certainty. There's not going to be policy certainty under this administration, given what we've had in the last few months. The damage is already done and entrenched. It's just what scale of damage we're going to get. So for business owners, for long-term investors, no, it's not much relief. For day traders, it's wonderful. It means they can make money on the way down and on the way up. But the ultimate trends will not change direction. Dollar has more to go down over the next couple of years. US stocks have more to underperform.
Mark, the clock's gone to zero, but I've got a moment, so I'm going to ask you another question. How long before we know what the new operating environment looks like? Is this the new operating environment? Huge amounts of uncertainty, massive swings. We don't know what's going to be the story from minute to minute, day to day, week to week, whatever it is. Is this the new world, or is this a transition period we're in to a new world?
I think it'll calm down a lot next year. So it is a transition period. It's an aggressive transition period. Ultimately, this administration believes their package of policies will lead to a much stronger economy and a much better market well in time for the midterms next year. So maybe 12 months from now, we want to be, comfortably trading a more bullish scenario. And I think that involves less kind of policy whiplash. So I think at the moment we are in a bit of a transition period. It's what we're ultimately transitioning to. We're not transitioning to maybe quite the tough circumstances we've been in now, because we've only had the first couple of legs of the policy. We do expect tax cuts to come, and that'll provide more of a boost to US companies and to US assets. So I'm not saying it's all bad news forevermore. I'm just saying that the fundamental story is that we're raising the cost of business for US companies to do business all over the world, and that is going to be damaging for US companies that were overvalued. We're also incentivizing reserve managers around the world to cut their exposure to US assets and US dollar because they can be worried about what this administration might do and has talked about doing. And that means there's a long-term reason to keep on selling dollars over the next couple of years. So the long-term trends are in case, even though we're going to trade some good periods in that kind of long-term trend of dollar decline, we'll trade periods of tax cuts. And it's the same for US stocks. They will continue to underperform, but they'll underperform in bull markets when everything's rallying, it's just the rest of the world's rallying more, and they'll underperform and risk off when they're really selling off aggressively.
Wow, that's a big shift from what we've just seen. Mark, great stuff. Thank you very much indeed. Bloomberg Markets Executive Live Editor Mark Cudmore. MLIV is the function. You can find Mark and all the great views that are on the blog. It's there on your terminal. Easy to find. What's going on with the stock story? Joe Easton's here to tell us.
Morning, guys. So SAP's numbers looking really strong. The company reports a big jump in their order backlog for their cloud business. And here's what the stock did in the US after hours trading in terms of the ADR. We can see it up around 9%, and we've seen a 10% gain in the stock on the Tradegate exchange today as well. Now, SAP is, of course, the biggest listed company in Europe, vying for that position recently with the two luxury companies, LVMH and Hermes, but this now looking to cement its status as Europe's biggest listed company. Potentially, we're going to see a big gain in SAP in Germany today. And then in terms of the staple goods, we are looking at Reckitt. I had to check I was on the right order there. We are looking at both Reckitt and Danone. Both of these looking a bit weak. Reckitt in particular warning of some softness in the US consumer in particular, whereas Danone actually a bit stronger in terms of their yogurt and water sales, but actually slightly missing expectations on both. We can see Reckitt has been the underperformer of the two. That kind of related to some legal issues that the company has had, but both of those stocks are called lower by the traders and market makers this morning. Keep an eye on those ones. Then in terms of semis, BE Semi, this one looking weak as well out of Amsterdam. Margins missing estimates by a significant amount, and BE Semi actually warning that it's difficult to predict how the new tariff outlook is going to affect the company, and potentially that is going to have implications for the AI sector of their business, so potentially BE Semi going to be weak. The stock has already slumped, of course, kind of in line with its bigger rival ASML. We can see that stock losing around 30% on a one-year basis, so potentially some of that negativity priced in, but yet it may be a little bit of underperformance in a broadly positive market today. Then in terms of analyst ratings, two big ones that caught my eye. Vodafone, that's an underweight at JP Morgan today, and Inditex, the owner of Zara, Sephora is an outperformer. BNP Paribas, Exane, potentially that could be an outperformer, but heavily weighted stocks in focus on the rating changes.
Thank you very much, Joe. Joe Easton from our equities team. Let me just mention a couple of corporate stories that caught my eye this morning. Guy, we got news out of Continental. They are, of course, make parts for cars and things, and they are naming and giving a date for when they will spin off their standalone automotive company. It's called Almovio or Omovio.
So
I don't know how to say it.
So I think I've decoded it. So the AU first, so automotive, right?
Yes.
AUTOMO. So they've taken the first two, AU and MO, and then VO is Latin for to go.
Right, there we are.
So I'm presuming the VO is the kind of the bit at the end is the Latin bit, to go or to travel.
Excellent.
So
how much are you charging for this consultancy advice?
Precisely. That took about 5 minutes to figure out.
Amazing. Well, there we are. We've unpacked that one. So we'll watch that one. Interesting, they are talking about listing this in September. So despite all the global uncertainty, the volatility, companies going forward, continuing with their thinking around corporate activity, capital markets activity.
Yeah, it's interesting. So there's a couple of companies out there that I think are worth paying attention to. We were talking to Akzo earlier, talking about the fact that they've got local production. The UK chemical supplier Croda is introducing a tariff surcharge, which is interesting. So some within the chemical sector, and I guess we could put Akzo in that space as well, are having to deal with this in a different way.
Yeah.
Very different views on Danone this morning, and quite bleak on Volvo. So there's some interesting spread in terms of the stocks that are out there.
Individual corporates then could be in focus. Numbers out of Randstad, that stock could go higher as well on the labour market front. That is it for the opening trade this hour. Futures pointing higher.
Am I going home?
We'll be back. This is Bloomberg.
Wednesday morning, we're already halfway through the week. I know we had Monday off, but the Americans didn't. So yesterday morning, we spent a little bit of catch-up time with the European equity story. But after that, we pretty much mirrored what we saw stateside. And this was the rally we got in the States, and this was the rally we got towards the back end of the session for European equities. US markets sort of flip-flopped around a little bit after that, but obviously the big news of the afternoon was, A, the kind of the Bessent comments on what was happening with China and the fact that this wouldn't be permanent, that we'd find a deal, and then also we obviously get the president managing not to score an own goal and saying that he would not fire the chair of the Federal Reserve. So both of those two things are being taken as quite significant sort of positives at the moment. This is the effect they're having on Treasury. So let's talk a little bit about that. Plus, you've got to fold in a little bit of corporate news this morning. Anna will come on to that in just a moment. At the moment, the futures picture looks pretty positive, actually on both sides of the Atlantic, which I think is interesting. At the moment, the Stoxx 50 is up by nearly 2%. We're up by 1.9%. FTSE's only up by 1%, but has been an outperformer recently. The CAC 40 is up by around 1.4%. We'll see how the DAX opens this morning. There's some big names out of the DAX that are really worth paying attention to. The main one, of course, is SAP, Anna.
Yeah, absolutely. So we'll focus in on SAP. SAP of interest, positive news coming out of that particular business. Less exposure to tariffs, of course, if you're a software company. A sticky client base. And also the ADR has really responded positively to this. So we'll expect this one to go higher at the open. Reckitt is interesting as well. Consumer-facing business, of course, mixed, though, in terms of the numbers. Like-for-like sales missed, but the core numbers seem to be in line. Some weakening of the US consumer. Volvo Trucks, also interesting. Some weakness in the numbers there, but orders looked okay according to some of the analysts. Too soon, though, to assess tariff impact, and that seems to be a theme that we will come back to, Guy.
Absolutely. So here we go. We're going to find out. We're going to figure out exactly what these stocks, what these bourses, indices are going to do. Germany looks like it's going to be a big outperformer. It'll take a moment to get Germany open. So let's start with what is happening with the FTSE. It is climbing higher. We're up by around 0.2%. We're expecting it, once it's settled and everything is open, to be up circa 1%. Elsewhere, we're expecting a little bit more strength. The CAC 40 may be up by around 1.3, 1.4%. The Stoxx 600 is now up by 0.4%. I think you're going to see quite a big dispersion today in the individual stock story. So you can see SAP potentially up at one end, potentially up sort of 8, 9, 10%, that's what we're looking at. But you're going to see other names, maybe some of the staples names. There could be some quite significant dispersion there. We'll see what happens with these individual stock stories. Feels a bit more of a bottom-up story as we get into earnings season than it has been of late. The CAC is up by 1.1% this morning. Actually, now the FTSE 100 appears to be outperforming those two markets neck and neck. The IBEX is up by 1.34%, but it is the DAX that I am waiting for. It is SAP. I want to see how high this stock goes this morning, Anna.
Yes, OK. We are certainly waiting for that SAP number then. In terms of the sectors that we have on the move this morning, it's the banking sector that's at the top of the grid. Banking and basic resources sort of competing it out to be the best performing sectors this this morning. So this is a sort of risk-on sense in markets, picking up from those comments around the tariffs in China won't be as high as they are right now, according to both Trump and Bessent. So that's positive for risk sentiment. And also the lines around the Fed chair and not removing him, that's positive for risk sentiment. In terms of the negative sectors, I just see one, and Reckitt Benckiser seems to be one of the victims there, down by 2.6% on the Reckitt Benckiser stock on the back of the numbers coming out. Just said that they've been described as mixed by some of the analysts. Well, clearly the negatives dominating, and it's the like-for-like sales that missed, and some weakness in the US consumer as well. I wonder if that's a line that weighs heavy on the stock this morning.
Well, I think it's also interesting. So Reckitt is down, but you've also got some of the defence names down. Now, I wonder whether that's in reaction to some of the names that we've seen posting numbers out of the United States, or whether actually people just rotate out of what has done well recently and rotate back into maybe a more nuanced earnings story. So I think that'll be interesting, really interesting to watch. AP Møller-Mærsk is up really strongly this morning. That's a name that I think is worth paying attention to. In terms of where the points are being added, HSBC, ASML, Novo Nordisk bounced back quite strongly, Shell and Roche. It's a really mixed picture in terms of the overall performance that we're seeing out of Europe this morning. And I feel we're going to go into a less index-orientated, more single stock sort of story, which I think will be really interesting as the different messages begin to emerge. Have we got an SAP trade? We got
Apparently so. Up
10%.
There we go. Up 10% on SAP. So it seems that the numbers came in better than expected. There is some resilience, perhaps, around some of these services businesses, given that one of the big threats right now is tariffs. And a big obsession this earnings season is going to be tariffs. So businesses that can step aside from that, at least in terms of direct impact. There's always the question of indirect impact, and we were discussing this with the Akzo Nobel CEO a little earlier on. So there we are. The DAX is up pretty strongly on the back of those SAP numbers. The DAX up 2.4% with strength coming from SAP. Joining us now to talk about the markets, Bernie Akong, Global Multi-Strategy Alpha CIO at UBS O'Connor. Bernie, very nice to have you with us. Interesting dynamic, interesting sentiment in markets, I suppose, today, yesterday and today. Much more positive. Key lines on China, key lines on the Federal Reserve coming through from the US administration. But they're kind of just writing other comments that the US administration had previously made. So looking through all of that volatility day to day, how risk-on are you feeling about global markets?
I think tactically in the near term, I'm feeling, a lot more constructive than I have been for a while. I think people got too bearish coming into Monday. And whilst, yes, I agree with, the consensus that there's lots of concerns over the coming quarters, I think the short-term positioning and sentiment has gone quite far. I think there was, for me, very little chance that Trump was ever going to really go down the path of firing Powell. I think we are going to get some trade deals, maybe not with China, but I think places like Japan and India are very credible and they want to do deals. So I think in the near term, there is a roadmap for more risk-on, and particularly not just more dispersion, but you mentioned it just then, Guy. I think cycles versus defensives, they've underperformed a lot. There's scope for some, sort of relief rally and bounce here. And if you look underneath the surface, cycles are pricing in a lot of negative news now.
So is this because we made too much of the end of US exceptionalism idea and actually that was all overblown? Or is that idea still in place and this is just a sort of short-term risk relief rally?
I think it's more the idea is in place, but these things take time. Don't forget, a lot of the big pools of capital meet on a quarterly basis to make decisions. So what happens is shorter term parts of capital do move very quickly, but if everyone moves in the same direction, the same door at the same time, you know what happens, right? We overextend, and that's what's happened here. I think it will continue over the coming quarters, but in the short term it's just, overextended. When you look at different indicators, they are at levels which suggest we have some sort of tactical relief rally. Yeah.
Is any risk rally going to be sort of constrained by the fact that risk management is probably on high alert at the moment? The risk managers are watching what is happening very carefully, constraining potentially kind of the swings that we're going to see, particularly to the upside. Don't take too much risk. Keep it under control. We need to watch out. The risk for a shock here is significant.
For sure, but don't forget that a lot of institutional investors have already taken down risk a lot, right? For example, on the hedge fund space, I would say we've already done a lot of that. So actually there is scope for re-risking if things in the short term aren't as bad as they turn out to be. And let's face it, we are, not just hedge funds, actually, everyone is very short-term performance-oriented. So if suddenly it looks like on the next 1 to 2 months it's not going to be a disaster, we might get some trade deals, and guess what? Earnings aren't going to be completely terrible, then actually, there is scope for re-risking, and retail can still.
How
buy
far
more.
does that go? How far? I think that's the question I'm really asking.
So S&P can get back to 57, 5,800 in a good case scenario, I think. But I think I would say longer-term money should be looking to sell on those rallies. But for shorter-term tactical money, there is still, meaningful upside, particularly, I would say, in some of the cyclical equities in the short term.
Bernie, one of the things you mentioned in your notes is the role of AI. And, before we were talking so much about tariffs, we talked a lot about AI, so it's nice to go back to that sometimes. The role of AI and the job cut story. So we're watching jobs for a number of reasons, partly because of the tariff threat to the United States, and we're thinking about, is this going to take its toll on the labour market? But some of that might be, just a sign of economic weakness, and some of that might be a pivot into AI instead of people doing jobs. How are you thinking about what the jobs market will tell us and the AI story?
Yeah, I think it's a great question, and it's very linked, and I think the timing of it means that corporates can use that as an excuse, right? So it would be a justifiable excuse to reduce headcount, and we've already seen, I think even SAP mentioned it today, if they need to react, they're not seeing anything, but if they need to react, they will adjust the cost base. And part of adjusting the cost base is going to be headcount. And it's going to be easy for companies to say, well, we can afford to adjust the headcount here because suddenly we are increasing productivity through AI measures. So I think that is something we're going to see come through in the coming quarters, even as potentially the economy starts to slow down. There will still be positive spending on the AI side, which is offsetting some of that.
So companies, just following up on that, companies then that don't have much tariff exposure and can replace people with technology, is that something of a sweet spot?
Absolutely. There's winners and losers. I agree with the guy's point. There's dispersion. The thing is, right now, the correlation has been so high because we've just been thinking about this immediate short-term effect. When you think on a go-forward basis, there's so much differentiation between geographic exposure, supply chain exposure, the ability to cut headcount or not, AI usage. I think that's the interesting story from here.
Should we all go to California to understand what's going on?
Yeah, I mean, we were talking about just now. I think I just come back from 2 weeks in California with a family, and we were all traveling on the Waymo and autonomous vehicles. And at the start of it, my wife was saying, absolutely don't know where I'm getting in this. And by the end of it, she was saying, bring these to London. They're so safe. The driver's not falling asleep. Don't have to make conversation. So I think, look, this is another one of the examples of how, things are changing, even if we're going to have a sort of more tricky economic backdrop. There will be positive change.
In terms of kind of how we think about where we go from here, an Amundi note caught me. I'd love to carry on talking about Waymos. The Tesla conversation. We're going to have the Tesla conversation a little bit later, so we'll carry on with it then. There's a note out from Amundi saying clients are massively repositioning to Europe. When you think about how the last few years has been, you want to outperform, you're long the US. Has that now changed? It almost does come back to the California conversation as well.
Yeah.
If I wanted to do well, if I wanted my book to do well, I have needed to be long US. I've needed to be long US tech. That has been the trade. Has that now shifted? Should we be massively long Europe, or do we ultimately go back to Do we go back to the AI trade? Do we go back to where we were a few months back? Because this, I can't work out what phase we're in at the moment or what we're transitioning to.
I mean, I'm not sure any of us can exactly with confidence, but I would say to that question, I don't think it's a blanket, let's rotate everything back into Europe out of the US. Because if you really do believe that we're going to have a global recession, unfortunately, there is a large chunk of Europeans' market cap, which is very sensitive to that, is not going to be resilient to that. So allocators who allocate to, the Euro stocks thinking that they'll be, defended and safe because of that rotation, unfortunately, going to be a negative surprise. What I do think is the case, though, is that what's going to be particularly appealing in Europe is defensives in an environment where the ECB is cutting rates.
Right.
And companies plugged into that German fiscal spending, which are going to benefit and outperform and probably re-rate in a way that they didn't have a chance to re-rate before because people were allocating instead to the US. Now they're looking to allocate to Europe, and so they will look for names which have that potential. So I think there are pockets of Europe which can do very well. I think actually SAP is actually one of the superstars that we have in Europe. We talked before about ASML and LV and Novos, and unfortunately, look what's happened there. I genuinely think SAP is the one which we should have been talking about more and will continue to shine on a multi-year basis because it has something really differentiated, and that will attract capital and allocators to the
And should Europe spend time thinking about the tech it doesn't do, or focus on the tech it does do and do more of it? Bernie, given where, you know, the tech experience that you've had of late, and you know, the thinking around AI and where that.
I think it will take to focus on new stuff will require some of the Draghi's suggestions to really be implemented. Will take many years, and I think, as we've all seen politically, that's difficult in Europe. I think Europe should focus more on what it really can do, channel more resources towards that. So whether that's, you know, champions like SAP, whether that's pockets of actually energy transition. Energy transition is not dead, by the way. I know offshore wind is dead, but actually there's parts of energy transition throughout the world where we can help the rest of the world with their journey, and we should focus on areas like that.
Lunch?
Lunch, nearby, I Cabot. I'm off to later today, maybe not for lunch, maybe for dinner, but that's a French restaurant. Amazing Burgundy wine list, very reasonable, good, simple food, but executed really well.
Excellent.
Very good, very good. We should explain that Bernie does have a sideline in restaurant recommendations in his newsletter.
One day mainline.
Honestly, we should do it with more guests. Like, where are you going for lunch today? I think that would be an excellent thing that we could add to the show.
Happy to contribute.
Bernie, great to see you. Thank you very much indeed for stopping by to see us. Bernie Ocon, Global Multi-Strategy Alpha CIO, joining us from UBS O'Connor. Core 6 looks like this morning. Don't have SAP on this board, probably should, but as you can see, everything appears to be up. Nestle is languishing on the right-hand side, but look at it. Novo, LVMH up quite nicely. Ferrari, ASML up nicely as well. Schneider up by 1.5%, but SAP is the star of the show this morning. Joe Easton's got more details.
So SAP is really the place to start, Guy, because that stock actually rising the most in around 6 years today. Now, Deutsche Bank writing that it is a masterclass in resilience, according to their analyst today in a note. They've seen a massive jump in the cloud order backlog, as we mentioned earlier. So that stock surging on the German market. We're up around 9%, by far the best performer on that market today. Then in terms of BE Semi, this one actually kind of catching everyone by surprise, because most of the takes I read were pretty negative on this, with the margin outlook pretty weak and also the comments around tariffs potentially negative. But potentially it's been saved a little bit by the moves we saw in the US and also in the other chip makers today, given the comments around the Fed and the broader economy. We saw Nvidia up around 3.5% after the close yesterday, so potentially feeding through, but actually extending gains now. So kind of really not moving in line with the analyst commentary, sadly for me, but that one gaining pretty well today. Then, in terms of staple goods, we are all buying a lot of Dettol, according to Reckitt. Dettol sales absolutely soaring, but the rest of the business is weak. So we're cleaning our houses a lot, but the rest of the home business actually underperforming, and therefore organic sales at Reckitt actually really disappointing. That is a big move for a company that size. It is one of the biggest weights on the FTSE 100. Danone in Evian water, and also all those yogurts also slipping following their earnings as well. Then in terms of Volvo, it's a pretty weak update from that company as well. This is the truck firm. The order's looking a little bit soft on that one. And remember, there's a lot going on in terms of the environmental regulations in the US. So a lot of headwinds, and Volvo looking a bit weak. First quarter adjusted operating profit missing expectations. Then I wanted to look at gold miners. Absolutely slammed this morning. Take a look at some of these. Hochschild Mining London down 13%. Fresnillo down 8%. Endeavour, Pan African all down, following only a 2% drop in the gold price overnight, but a pretty big move for gold. And we did see Asian miners coming down as well. The positive risk sentiment reducing the appetite for those safe havens and hitting the gold miners today. And then finally, speaking of safe havens, Inditex, that upgrade over at BNP Paribas Exane, the bank writing that this is a way to be resilient from tariff worries because of the Zara owner's strong supply chain, apparently is a reason why Inditex will outperform. So that's the real safe haven trade, is the Zara retail owner, according to BNP Paribas, and that one is up 1.8% in Madrid this morning.
Joe, thank you very much. Joe Easton from our equities team with food for thought around where stocks are right now, following on from Bernie's restaurant recommendations. Let's get to PMIs over in France. The French April composite PMI falling to 47.3. That was against a forecast of 47.8. So it was already expected to be in contraction territory, and it already was last month as well. It was at 48. So it's dropped down from where it was previously, and it's lower than than anticipated. So that's not a great story when it comes to the composite number. Looking at the detail then, manufacturing seems to be better than was expected, but it's the services side that the weakness has come through here in France. So 46.8 is the French services PMI number. I remember a year or so ago we talked a lot about Americans coming to Europe and spending on services. And, you know, we'll look into the detail, but that's a question you'd ask, isn't it? Whether that continues.
Ben Smith at Air France sort of just cautioning what is happening on the transatlantic route. I thought that was interesting from Air France, from Ben Smith. It's interesting in light as well of the fact that Macron is talking about calling an early election. And you just wonder what is happening within the French economy right now, whether or not he would be brave to do so, given the fact that the economic backdrop does look maybe more difficult than we would have anticipated. At the service side of the French economy, it's still a massive, huge chunk of the French economy. 46.8 is not a good number by any stretch of the imagination. We've seen worse, but that is not a good number.
It's not a good number. We're waiting for the German number. That drops later on this hour. We're not seeing a huge amount of movement in euro-dollar being driven by other things, perhaps, of late. And so we will leave that one there. But we'll come back to this theme with the German data, and then, of course, the Eurozone number drops in less than an hour. Coming up on the programme, Europe's most valuable company tells us business is strong, despite concerns over US tariffs. We will hear from SAP CEO and dissect the firm's first quarter earnings next. This is Bloomberg.
No pullback on spending on SAP. I mean, obviously, what they are telling me is, Christian, help me to, drive productivity. Give me more AI on asset management, on supply chain. How can I automate several tasks in my back office functions? I mean, that is, of course, what they are now more and more asking for, given, that they are under financial pressure. But what we are not seeing yet is that they are actually delaying projects or even cutting projects.
Christian Klein's having a good morning. SAP's CEO, the stock is absolutely charging higher. It has been dipping of late, so let's just put it in context, the fact that this isn't a stock that's trading at highs, but it is certainly having a very good day. Charlie Wells is here to unpack the earnings. Investors like it. I think that's probably the first takeaway.
Investors like it. They like the sort of insulating factor that we've got here because tech, we know, more broadly, has been under a lot of pressure. There's all these questions about tariffs. But if you look at these numbers, they beat on earnings per share. They missed a little bit on some revenue figures. But the number to focus on here is margin. It was 27.2%. That beat consensus by 250 basis points. And this is a validation of their strategy. And that strategy is moving to the cloud where margins are just much better.
OK, so the move to the cloud continues. What impact are tariffs having here? This isn't a direct impact story, is it, Charlie? It's indirect.
It's more of an indirect story. And, what they talked about on their earnings call was basically they've got this kind of insulating factor. They have got this current cloud backlog, which is incredibly healthy. They saw growth of about 29%. And this is basically, contracts that they've signed, but revenue that they can't book until the future. And so it's just looking very healthy. Even if we get into a period of uncertainty, of instability over the next, say, 12 months or so, they've got this revenue that they can look forward to, and that is what's bringing a lot of excitement to this stock right now.
Matching, I think you call that.
Yeah.
I'm digging that deep in the recesses. I'm having accounting trauma right now as you talk about that, Charlie. But it's the matching principle.
She tries to repress it, but it comes out. It comes out every once in a while. Is there a read across to the rest of the sector? Is SAP isolated, or is it useful as a barometer?
There's kind of a framework to think about tech right now, especially given tariffs and uncertainty. I think especially emphasis on uncertainty, which is in times like these, companies tend to kind of pull back on IT spend, right?
Yep.
They tend to pull back on consulting. There's not a huge kind of consulting focus at SAP. Sometimes you'll also see some bad signs coming from software companies where they're really dependent on headcount, right? Where the more employees that customers have, the better because they need, say, more licenses or whatever.
Yep.
SAP is not really subject to that. Some of its competitors are, right? Salesforce, they're a little bit more dependent on these firms having high headcount. If we get into a bad situation economically, the headcount could be cut.
Charlie, thank you very much. Charlie Wells on SAP. Let's pivot from that to another earnings story. Elon Musk says he will devote more time to Tesla starting next month as his stint leading the so-called DOGE, Department of Government Efficiency, is wound down. Investors have taken Musk's decision to focus on the EV maker as a positive move.
starting probably in next month, May, my time allocation to Doge will drop significantly. I'll have to continue doing it for, I think, probably the remainder of the president's term, just to make sure that the waste and fraud that we stop does not come roaring back.
Tesla stock rose in late trade after this announcement, the commitment to spend more time at Tesla, despite the company's first quarter results missing analysts' estimates. For more, let's bring in Bloomberg's Craig Trudell. Craig, is investor positive sentiment, is it misplaced? I mean, the numbers were not good.
Yeah, top and bottom line misses. These were really weak numbers, and I think I do have to sort of highlight as well that while Musk was talking about devoting significantly more time to Tesla, starting sometime next month, he also said that as for the remainder of Trump's presidency, as long as Trump wants him, he may devote a day or two a week to this administration. So, is he completely pulling back? No. Is he? Was he at all contrite or sort of, apologetic or humble about things? In fact, he was, saying that everyone who's been protesting against him is just out, for that fraud and abuse that he's fighting, and he's going to keep fighting it.
What is going on? Is this a car company? I'm trying to understand why the stock went up. Is it because he's coming back? Is it because he focused on the shiny things of robotics and self-driving cybercabs and all that sort of stuff? What is it that got the stock higher? What is it that he did that was taken so well?
I've learned not to try to overread into what the stock is doing on a day-to-day basis, because it is quite difficult. I do think a combination of Musk at least messaging that, I understand I've got an issue here. I do need to kind of, get back to my knitting of running my most important company. Is at least an acknowledgement on his part that, this isn't working. I do think also there was a lot of concern about maybe some delays to more affordable vehicles being on the way. There was, some reference to the idea that actually those are still coming in the first half, but still extremely vague on what exactly those are. And so I do think that there are some analysts, even bullish analysts, who still say that, the numbers were weak and there was kind of shaky details in this report.
Just very briefly, what's the news out of the Shanghai Auto Show? What's the mood? What should I take away in aggregate?
That the Chinese are just absolutely relentless, that, on a week-to-week basis, one major company is one-upping the next. You're not seeing that level of competitive activity in the rest of the auto sector that comes anywhere near what the Chinese are doing.
Great stuff, Craig.
Yeah, thank you very much. Craig Trudell. We'll be back with the German PMIs. That data breaking shortly. We've had the French number. The services number looked pretty weak. We will see what the German number adds to the mix. The ECB already cutting interest rates, though, as the tariff threat looms. Of course, in Germany, you have the fiscal spend to factor in. This is Bloomberg.
Welcome back. You are watching the opening trade. We are getting the German PMI data dropping onto the screen. I managed to just very briefly change my screen, so let me go back to it. The numbers come in below expectations, quite significantly below expectations. Manufacturing PMI comes through at 48, down from 48.3. That actually is above expectations. I tell a lie. The services number, though, is weak at 48.8, below 50. That takes the comp number below 50.
Yeah.
49.7.
Yeah, so we're back below 50 on Germany. That's suggesting contraction, of course, in that economy. And that's the services side again that's weaker.
Yeah.
And that was the story with France. And so that tells us something interesting, doesn't it? Because for a couple of years, it seems we've been talking about weakness in the manufacturing side in many parts of Europe. And here we have services weakness. And I go back to that point I made about lots of Americans visiting over the last few years and whether that remains the case. We'll dig into some detail and get a proper take on what it is that's driving that services weakness. Do we see not a huge amount of euro-dollar movement?
No, you do. There's quite a lot of movement in the front end of the German curve, though. So the Shanghai is up by 7 basis points at the moment. The rest of Europe's not doing anything like that. France is moving a little bit this morning. Well, actually, France is, to be fair, up by nearly 6. But you are getting some decent movements. at the front end of the curve. Euro dollar, let's have a quick look at and just see exactly what's going on there because...
Hasn't really moved. 114.
Okay. I'll take your word for that. 114. I get relative strength compared with been
driven by all sorts of other factors a lot of late, so perhaps this little bit of data...
But as you pointed out earlier, we're kind of caught, particularly in Germany, between the tariff hit and understanding the implications of that... and what is happening more broadly in terms of the fiscal spend that is coming and how you kind of sequence those, I think is going to be quite interesting. Joining us now, John Taylor, Director of Global Multi-Sector and Head of European Fixed Income at AllianceBernstein. Good morning.
Good morning.
What do I make of this, Joe? What is happening in Europe at the moment? Because Europe is in some ways behaving. The European bond market is kind of doing what investors need it to do, which is acting as a kind of counter to what is happening with the European stock story. But what do you think is going on underlying that? What is happening with the European economy right now?
Things are pretty slow.
Yep.
The most important thing for Europe is that the disinflation trend is firmly intact. So inflation is going to get back to target and maybe even undershoot the target. You can't make that same story up for the US. Who knows where inflation is going to be over the next year or so. It makes the Fed's decision much more problematic. The ECB, it's pretty straightforward. Today's PMIs numbers show again, growth is pretty weak. There's no real inflation problem to worry about. The ECB will and have to keep on cutting interest rates and take them below neutral. So no one quite knows what neutral is because we had a huge amount of time with negative rates and then policy at 4, but let's say neutral is somewhere around 2. Policy has to go below.
So we go below 2.
Yes.
Right. Because there's some resistance within, it seems, the governing council maybe to be going below into accommodative territory. So once you've made that decision to go there, how much can you get? Where can we go? Can we go all the way down to 0 again? Is it? I
think they're going to want to stay away from that negative policy. Right. That was a temporary measure.
So where's the floor, do you think?
Somewhere probably around 1.
Right.
Just to give them a little bit of room. If something then happens, exogenous shock, they can respond. They don't want to get too close to 0 and then their hands are kind of tied again. But policy should go to 1.5. It could even go lower. It really depends on kind of the next few weeks and months, the tariff negotiations, how big that economic hit is going to be to Europe, and then how much they need to cut policy to help respond to that.
Guy was referencing this earlier. The way that Europe is seeing bond markets act as a haven, John, is that, and whereas in the United States that's not necessarily been the case, that relationship between stocks and bonds disrupted in the States, maybe not so much here in Europe. Is that something you're seeing and something you're leaning into?
Yeah, so we definitely favour having our duration in a global portfolio outside of the US. That's not to say that US yields can't go lower, but there's just much more uncertainty around what's going to drive US yields. It wasn't that long ago that people were talking about 10-year US yields going to 6%. In Europe, I think the story is much more straightforward. There isn't that inflation problem. There's no challenge to the central bank's independence and so on and so forth, and therefore the German Bund is becoming more of the safe haven away from things like US Treasuries. Whether that's a temporary measure or something longer lasting, I think only time will tell.
And is that just European money coming to that conclusion, or do you think global money is coming to that conclusion as well?
I think global money is starting to come to that conclusion. It'll take time to really see that play out. Part of the problem you have as well is for many global investors, when they're investing overseas and hedging that currency risk back, it doesn't often make sense to own those global bond yields. The more the ECB cut, the more it reduces those FX hedging costs, the more attractive European bond markets become for global investors.
I was talking to Barney Boasia about this yesterday. There was a period, the Greenspan sort of conundrum was that he was hiking rates and you weren't getting much movement in the US 10-year. The curve wasn't responding in the way that he thought it would, and he was confused by this. And the reason it seemed, and Bernanke kind of provided the answer for this, was that the US became the parking place for a lot of global money, and that basically restrained the move that we saw in US 10 years. Are we going to get the exact opposite this time? That the Fed could cut rates and Trump could kind of get what he wants, but actually the cost of money stays kind of relatively high in the US because that international money, as you say, isn't going to be there. And we almost get the kind of the reverse Greenspan.
Yeah, there is a risk of that. I think part of it is the globalisation trend that's now sort of seemingly in reverse. Less overseas investors have US dollars as a result of trading, and so they don't need to park that money in US Treasuries, etc. You are seeing that steepening of the curve, and it probably can carry on for the time being. It has steepened quite a lot already. You have this issue where the debt to GDP ratio just keeps going up and up and up, and no one's taking any steps to address that, and it therefore needs a bigger term premium that has been playing out really over the last 6 or 12 months or so, even before Trump came in.
So how far through that process do you think we are? If you assume that US deficits are going to get bigger and the money is not going to be coming from the rest, how much? Where can the back end go?
Yeah, it's a really good question, because if we think about it, at the start of the year, it's a much easier trade to put on because the curve was very flat versus history, which made no real sense. Now we're back to levels where it's kind of the 530s curve is roughly around the long-term averages. So it should go a little bit further, given the situation we face today of slowing growth and the deteriorating debt to GDP. Maybe another 25 basis points or so. Part of the problem is I'm not the only person talking about the curve steepening trade, and therefore what often happens is you get these kind of sharp reversals where people kind of unwind and then it sort of goes again. So it won't be a straight ride up, but it probably has further to go over the coming months.
And John, what about feed the gilt story into what we're seeing? Because we've talked about bunds as a bit of a haven. I mean, gilts are doing something else today. We talked about the Treasury story being, less of a haven, certainly the long end. Where does the gilt market fit in amongst all of that?
So the gilt market is living with the hangover of the Truss episode, and so the long end of the gilt market is very sensitive to any news about demand-supply imbalance, so reacting favourably today because of the DMO remit. Gilts are cheap versus bunds. They're trading over 200 basis points higher than bund yields, but they're likely to stay cheap for an extended period of time because of the situation that the Labour government have got themselves in, where they just give themselves a little bit of fiscal headroom, and then if yields rise, which might be a global phenomenon, or if growth disappoints, the fiscal headroom disappears and they have to come back and address it. So they have to constantly prove that they are going to be fiscally disciplined. And therefore...
How do you get away from that need to constantly prove it?
They probably need to break their election pledge and do something on the tax front side and give themselves a much bigger fiscal headroom. The easier way to play gilts is actually probably in the shorter part of the curve, which are going to be less responsive to these demand-supply imbalances and going to be more responsive to what the Bank of England are doing. We have a view that the Bank of England are going to cut more than the market is priced in, and actually the more that the Labour government gets challenged on the fiscal side, the more their policies are weaker for growth and actually increase the likelihood that the Bank of England need to do more.
Is there a danger that it gets out of control again? UK government borrowing this morning, the data, official forecast, exceeding official forecast, budget deficit 151.9 billion. These are difficult numbers, and as you say, the margin is incredibly fine. Is there a danger that it could get away from them? What's the hair trigger like within the gilt market at the moment? How sensitive is it?
It's not going to be a repeat of the Truss episode. Right. A lot of that leverage player is kind of been removed. But let's not kid ourselves. The very strong demand we've had for gilts for many, many years has faded away somewhat as pension funds have rebalanced and so on and so forth. During that period, the DMO increased the average maturity of gilts quite a lot. So what they have got the flexibility of doing is actually just reducing where on the curve they issue. The average maturity of gilts is much longer than international comparisons, so they can just issue more shorter-term gilts where there is going to be that more demand, and so they can manage this problem pretty well.
Great to see you. Thanks for stopping by to see us. John Taylor, Director of Global Multi-Sector and Head of European Fixed Income at AllianceBernstein. OK, what have we got coming up for you? Could it be the time to buy market volatility? You've got US big tech firms that are about to report numbers. We're looking for Intel as well. We've got SAP to fold into the mix. Claire Playdale-Bouveret is going to be joining us from Lion Trust. The pictures out of the Vatican are amazing.
Yeah, they are really colourful and quite stunning. Pope Francis's body has arrived at St. Peter's Basilica. He will now lie in state for 3 days, allowing the Catholic faithful to pay their respects. Welcome back to the opening trade, 8:43 here in London. We have strength coming through, in particular for the German market, up by 2.3%. And one of the reasons for that this morning is the strength coming out of SAP. That particular share price up by 9% this morning, soaring the most in 6 years after profits beat estimates for the German software company. Let's bring in Claire Playdale-Bouveret, who is a fund manager at Lion Trust, to talk about all things tech. And there are many things tech to talk about this morning, Claire. Well, let's start with SAP, but we have a host of earnings stories to cover. So SAP doing really well, up by 9%. It's not coming off highs. It's sort of retracing back towards some strength. But what is your view on SAP? You're not such a fan of SAP as maybe some of our earlier guests, I think.
So the results we got out from SAP last night were very, very solid. And I think as an investor in technology, it was comforting to see that companies' earnings power haven't contracted by 30%, even though some of their valuations have over the past month or so. SAP really occupies and epitomizes an area of the market, though, that we're very cautious on, which is legacy enterprise software. And this is because we're seeing a tectonic shift in the way that software is architected. And what we're seeing from a number of AI-native companies is the ability to undercut the likes of SAP by as much as 30-fold on price. You think about this, if you're built on accelerated computing, which is 100 times faster, 98% cheaper than traditional compute, that's an inbuilt architectural advantage. So what we see over the next 5 years, and we think this disruption is going to be very, very gradual because SAP, 86% of its revenues are recurring. These companies have got sticky business models. Exactly. I mean, this is why they've been such fantastic investments over the past 10 years. But we don't think that these moats, that these software as a service business models, we don't think they necessarily hold anymore, because we're going to have to see a recalibration of pricing models if they're going to compete with some of these challenges.
Can SAP migrate to that world, though? It was interesting, we were hearing from the CEO a little bit earlier on, talking about the fact that he is shifting his business in that direction. Are you saying that that is a journey that they are going to take too long with, and ultimately, therefore, others will get in first?
It's an excellent question, and SAP is certainly making significant strides. We think they're further along than a lot of their enterprise software peers.
Yeah.
But if you think about sort of building a software stack, it depends upon the foundations on which it's built. The analogy that we could draw is sort of your house. It depends upon the foundations on which it's built. Now, it's not impossible to re-architect, but it's very costly, and it is quite complicated. So if you're built on the wrong unit of compute from the outset, i.e. CPU, traditional compute, that's got to move over to accelerated computing. SAP are moving their customers to the cloud. They are rolling out some very decent AI offerings. There are a number of great stats last night thrown in the mix. I think their AI agent is now saving its customers 90 minutes a day. These are all great, but they're being built on top of legacy compute.
OK, and thinking of things that have been around for a while, you can tell us if it's legacy or not, but Intel is also in focus this morning, announcing plans this week to cut more than 20% of staff, this according to our reporting. Layoffs aimed at cutting bureaucracy. We've got a new CEO in place, and we understand he wants to focus much more on the engineering. Disappointed with the way that this business has lost ground to the likes of NVIDIA, perhaps?
Yeah, the announcement we got out of Intel this morning wasn't really a surprise to us. And going back to what we just discussed about this shift, Intel's on the wrong side of this shift. They really epitomise the traditional compute era, and we're now moving to accelerated compute. If you think about the 1980s, the Wintel era, the surprising part to us is that actually people aren't questioning the win part of that, the Microsoft dominance. We think that over the next 5 years, that's going to start being a question that people are asking. But with Intel, really, the design flaw in their business model stemmed from the decision to be an integrated device manufacturing company. And that meant that both on the foundry side, they fell behind TSMC because they were trying to make things that their own team were designing for them. And on the design side, they fell behind AMD and NVIDIA. And they're now 10 years behind and struggling to catch up. So not all that surprising, and we don't see an obvious route out for this company.
NVIDIA's traded this morning. They traded last night at I think overnight it's trading at 102. Do you like it at 102? Is this a good entry point? What we're seeing at the moment is that a lot of people are taking money out of the States. Now, when they were putting money into the States, if you wanted to kind of G up your portfolio and you wanted to add a little bit of sprinkle into it, sparkle into it, you'd buy some NVIDIA, and it did really well. That money's beginning to flow back out again. How do I separate out the fundamental story with NVIDIA at circa 100 from the end of US exceptionalism story, where people were kind of using Intel as the turbo for their portfolio performance? How do I work out kind of what's what?
So the opportunities that we're seeing at the moment in the market and have seen over the last month during volatility have definitely been on a stock-by-stock basis. We think it is a stock picker's market right now, and yes, we do like NVIDIA at 100. We liked it even more when it was trading on $93 a share in the wake of the tariff announcements. And these are the types of companies that we have been very active in topping up, because there is very little that's changed in these companies' fundamentals, in their earnings power, their trajectories. NVIDIA, if we think about...
Was it being valued fundamentally, though? Or was it being valued because everybody's just pouring money into America?
So, I mean, last year, NVIDIA grew its earnings at almost double the rate of its stock price. So it is very much a fundamental story. And the outlook, though, which I think is where you're getting here, I'll be buying into the promise of NVIDIA's continued growth. The outlook is still very, very strong. And this was underscored by TSMC's report last week. What we heard from TSMC was pretty astonishing. They're still expecting AI accelerators to double this year, but more importantly, over the next 5 years, they're maintaining that long-term outlook for AI accelerator growth, 40% compound annual growth rate. Now, if we take a very conservative haircut on that, and this is conservative because NVIDIA doubled its data center revenues last year, and say NVIDIA grows its data center revenues 30% compound annual growth rate over through the decade, you arrive at data center revenues of 430 billion, and consensus has penciled in 350 billion. So we think this company is being significantly undervalued at the moment.
So when 30% growth is conservative, we understand what you mean. So that's something leading edge, I suppose, isn't it, when we're talking about NVIDIA? Back to the sort of leading edge versus mature markets theme, Alphabet also reporting this week in terms of the tech landscape. And you say Google is in the innovator's dilemma. Talk to us about the headaches at Google.
So there's a certain irony that we've got a DOJ case investigating Google's illegal monopoly in search at precisely the same time that Google is being challenged for the first time in a decade. But what we've seen really since the launch of ChatGPT in December 2022, as well as the launch of Perplexity, which is a fantastic app I use it the entire time, what we've seen is that paid clicks per ad for Google have fallen off a cliff. They've declined over 30% since Q4 2022, and what you've seen are the worldwide active users of ChatGPT grow month on month by 15% or so. Now, the reason Google's in such a tricky spot is that they command 90% gross margins and 90% market share in search. So in order to compete with these chatbots, which actually give you answers as opposed to pages with sponsored links, they've got to undercut their very high-margin revenue streams. And at the moment, they're going for a compromise approach.
They're putting some AI
They're putting some AI, but they're still trying to put ads in there. And that detracts from the user experience. And this will be a gentle erosion of market share and margins. People are very habitual, but what you're seeing in the younger generations across geographies is that they're not going to Google anymore for their information.
No.
That makes me feel young. I've occasionally dabbled in a chatbot, so that makes me feel young. Thanks, Claire.
Well, yeah, I have to say, watching my children use this stuff, it's amazing how they are migrating and migrating quite quickly. Though my son was slightly frustrated yesterday that one of them couldn't understand him quite as well as he thought it should have done when he was speaking to it, which was the way that he increasingly uses it. Claire, nice to see you. Thank you very much indeed. Lion Trust Fund Manager Claire Playdale-Bouvray. Thank you very much indeed. OK, let's talk a bit about what we've got coming up for the rest of the day. We're not done. PMIs continue.
Yeah, we've had the PMI news out of France and out of Germany. We do see a little bit of downward drift on the euro now in terms of what impact this had. And you were drawing our attention to some of the moves in the Bund a little bit earlier on. But the story has been disappointment around services, hasn't it, so far? And then we get the overall Eurozone number a little bit later. UK PMIs, we get US PMIs as well. We hear from Andrew Bailey. So there's lots on deck in terms of the conversation. And the Fed Beige Book, I think that'll be really interesting.
You're excited by
anecdotal. I'm excited by beige. What can I say? Yeah, all the little anecdotes about the US economy. I'm looking to my right because Valerie Titel has joined us, and I'm sure she gets excited about beige as well. Valerie, where should we start? Do you want to talk about the Yeah, where shall we start?
Well, look, I do think the Beige Book will be interesting. You know, that kind of off-the-cuff information from business leaders and how they're interacting or interpreting the tariffs and reaction will be important. But one thing I think is going to be a bit more important going forward is keeping our eye on the lawsuits brought forward against Trump tariffs. Now, there have been a few of them now. They've piled up. You know, it's been 3 weeks since April 2nd. And many out there are talking about a lawsuit by a libertarian think tank representing small businesses in the U.S. Court of International Trade, which is squarely focused on the president's use of the emergency powers. That's the IEEPA, the IEEPA Act that he's been using in order to implement these tariffs, saying it's unconstitutional to use IEEPA to implement tariffs and arguing the president has overstepped his authority. Now, the important date in your calendar is May 6th. Next week, this court will have a hearing over possibly allowing an injunction, which would be an emergency block on the tariffs until the court decides on the case. Now, this could be the first ruling on whether a court would put the tariffs on hold actually during the process before they make a decision, but it could be huge. And many people are talking about this because the likelihood of one of these cases making it to the Supreme Court, while that is small, Guy, it could be very large because since 2021, the Supreme Court has actually invalidated several presidential initiatives under the IEEPA rule, with the Biden student loan forgiveness program, the COVID vaccine mandate, even the pandemic eviction moratorium were all eventually invalidated by the Supreme Court. So, you know, even though the chance is small, the likelihood of one of these making the Supreme Court could have huge ramifications for presidential power.
You do wonder whether ultimately, though, that when presidents, and FDR is the obvious example, have gone up against Supreme Courts and the Supreme Court, there's always been some sort of understanding that was ultimately reached. Trump will say, "This is the will of the people. They have voted me in. This is what I'm going to try and do. Why should I be frustrated by the court?" Even a right-leaning court like the Supreme Court, you do wonder whether this is a speed bump rather than a permanent kind of end to the story.
Yeah, but you have to think that even though the chance of this is very small, just think about the market reaction if the court does impose a temporary injunction on these tariffs, meaning they're completely invalidated. I mean, that would be a day would be limit up in the equity market. So even though the risk is small, we keep our eye on its developments.
Okay, certainly worth putting on our radar. Thank you very much, Bloomberg's Valerie Teitel. So we've had some of the PMI data. We'll get more of it coming up. We'll also be hearing from all of these IMF and World Bank meetings, of course. We'll have full coverage of those spring meetings. We'll be hearing from the Bundesbank president at 12:30 p.m. UK time, so stay with us for that. This is Bloomberg.